Hi, good morning and welcome back to our accounting series on Boardroom Forum Live. My name is Shreeya Jugnandan, an Associate Director at PwC's Corporate Reporting Services. Today joining me, I have Liandie Kies, an Associate Director as well in my team in Corporate Reporting Services.
Good to be with you.
And today we are ecstatic to be talking to you about a brand new accounting standard, IFRS 18. Liandie is an IFRS 18 expert and has spent a number of years navigating the accounting and financial reporting landscape. So I'm really looking forward to reimagining the possible with you this morning, Liandie, as we talk about the primary financial statements of the future. So Liandie, give it to us in a nutshell. What is this new accounting standard about?
Well, Shreeya, you're right. So it's brand new. It has an effective date of 1 January 2027. And it's a rethink of IS1. So IS1, an old accounting standard, it tells us what our income statement, our balance sheet, and the notes need to look like. And I think what happened was that there isn't a lot of guidance that promoted consistency. So investors reached out to the board and said, entities are reporting operating profit, but across an industry, it's inconsistent. Entities are reporting management performance measures, but we can't, get clarity around whether those should be the same or, how do we understand what those measures are? So the board looked at these concerns and said, okay, we can address this as part of an accounting standard, and that's what we have in IFRS 18.
I love how you illustrated this is driven by an investor need, Liandie, because sometimes preparers can be so frustrated. What's the point of another accounting standard? So is it to drive consistency and comparability, Liandie?
Yeah, so I think that was one of the drivers around it, is enhanced comparability. So in the income statement now, the statement of profit and loss, there will be mandated subtotals, and operating profit is one. So to the extent you're preparing IFRS financial statements, you'll now have an operating profit, and there are definitions and more guidance around what would be in operating. And because of that, it's one of the examples where, consistency will be enhanced. And that's one of the main drivers. And I think, also with regards to management performance measures, if there's specific disclosures that have to be there, then you can understand what's different among entity, again, enhancing comparability.
Enhancing comparability. Are there any further tweaks to the income statement? You mentioned these subtotals and enhanced comparability from an operating profit perspective. What else is changing in our primary statements?
Yeah, so the income statement changed quite substantially. So we now have, within the statement of profit and loss, we have an operating category, an investing category, and a financing category. And there's very specific guidance around, how do we assess each of these categories. But I think in the standard, it's not only the income statement that's changed. There are a couple of other principles that have been enhanced, but on the income statement, a lot more guidance and a lot of focus around what are these categories and how do we think about them.
Liandie, those categories seem quite familiar. I'm sure accountants all over are thinking investing, operating, financing. This is sounding a bit like a cash flow statement, Liandie.
Absolutely, and the words are the same, but the accounting is not the same. So I think the board specifically said, we're going to make consequential changes to the cash flow statement as a result of IFRS 18.
Okay.
So IFRS 18 is the standard that's been updated, or the new standard. And as a result of that, we have a few changes to the cash flow statement. It's not a rework of the cash flow statement. In fact, the board actually has a separate research project that they're kicking off as part of the next cycle, where they'll look a research project on the cash flow statement. So there are some changes, but it's not aligned. So to the extent you have something in financing, it's not necessarily financing in the cash flow statement. So just something to be aware of, but there are, again, some changes to take note of.
Never a dull moment in the accounting universe.
Something to look forward
to. To look forward to. So we've got the income statement, a lot of rework done there, some light touches on the statement of cash flows. What about the balance sheet, Liandie? Any movement there?
So some of the parts in IS1 have been retained. So other comprehensive income remains. So there are some parts that haven't changed at all, and then there are some new principles that have been brought in.
Okay.
And one of those principles is guidance around aggregation and disaggregation, and that affects not only the income statement, that affects the primary financial statements and the notes. And it's quite a fundamental change, because previously, we had the primary financial statements and we had the notes. Now you have definitions or roles. So you have the role of the primary financial statements, which is to provide a useful and structured summary. And information that's material has to be part of your financial statements. So material information will be presented or disclosed, but how you go about identifying whether it's presented or disclosed goes about what is going to constitute a useful and structured summary, which then forms your primary financial statements, income statement, balance sheet, cash flow, and then what will then be presented in the notes. So it is an opportunity to take a look at, the guidance around aggregation and disaggregation. And you have something called trade and other receivables. Do you now meet the aggregation criteria to have that single line item? Or would IFRS 18 actually say, well, now there should be a split out? If you have, goodwill sitting as part of your intangibles, is that still the right accounting answer? So that principle is going to have an impact on the balance sheet, most likely.
I love the sense of optimism that underpins how you speak about this new standard. It's a golden opportunity to really rethink those primary financial statements. And from what I'm hearing about the categories you've described, do you think this is a good opportunity for entities to start reflecting their current business model in their primary financial statements?
It's a good point, right? So I think IFRS 18 also says that your income statement needs to be done, or your financial statements are on an entity basis. So it is a move towards, previously we've had subsidiary templates and everybody kind of uses the same. But the board says, well, look at each business and ask yourself whether apply IFRS 18 for that entity, for the business that it's in now. So one of the categories, and the main category that we have, is operating profit. Right? So I guess the question is, what is operating profit? How do I think about it? So that assessment is also at an entity level. So the consequence of that is around, well, how do I define operating? Is it everything that's revenue? Is it everything that's in P&L? How do I go about this distinction? And there are kind of two models, right? So the first one is to only have to ask yourself two questions. Do I have specified main business activities? Yes or no? Now, what are specified main business activities? Two things.
Yeah.
It can only be I invest in assets as my main business activity, or I provide financing to customers. What are examples? I invest in assets, insurers, investment property companies, investment entities. I provide financing to customers, banks. So those are examples. If that's the type of business, it means that's your main business activity, and all the income and expenses that would typically have been sitting in investing and financing will now sit as part of operating activities. If you don't have a specified main business activity, what now? Then the board says, okay, rather than go identify all the possible operating activities that could exist, ask yourself those two questions. If the answer is no, then the starting point's a little bit different. Then the starting point is take your TB. Take your TB, work through the TB, and identify items that are investing activities, put them in investing activities. Identify the items that are financing activities, put them in financing activities. The residual is operating activities.
Okay.
So hopefully that makes it a little bit easier for our corporates and our entities that don't have those specified main business activities, but it is an entity by entity assessment. And I think at groups that might have specified main business activities, that's absolutely fine too. So you could have, a big group that has more than one activity, and that's fine. Then you would have your activities that are specified main business activities that can be revenue, and you would have the other residual that will also then be part of operating. But it is an entity by entity assessment.
And that's quite key, Liandie, because you want me to do this on a per entity level, but my financial statements at a group level could then look a bit different to the sub, right?
Absolutely. And that's perfectly fine.
So we need to do a bit of soul searching at an entity level to really rethink what those financial statements will be looking like as a result of IFRS 18.
That's right.
You touched on something else that's brand new at the start of our conversation, MPMs, yet another acronym in the accounting universe. Maybe expand a bit on that for us, management performance measures.
Yeah, so management performance measures have been around for a while. And different jurisdictions and territories have looked at MPMs differently. So what is an MPM? An MPM is anything that's reported that management sees as a measure of their performance. So what the standard does is it had brand new guidance on how to identify an MPM. And then if you've identified an MPM, what do you disclose? What do you talk about once you have this MPM? The consequence of this is that some MPMs that are currently outside the financial statements now make their way into the financial statements. So the idea there is to have enough disclosure so that across, competitors, for example, you can identify what are reconciling items, what are the tax impacts. But I guess the ask is for MPMs to identify what are MPMs that are being presented or disclosed as part of the financial statements, inside or outside the financial statements, and then to do an assessment around what should it actually be in my financial statements. Once it's in, what do I need to disclose? So that's also a brand new leg that, necessarily hasn't been considered before.
And is that quite a specific assessment? So does IFRS 18 have some rules or protocols, or the floodgates open for MPMs, Liandie?
Yeah, that's a good question. So not every MPM is going to be an MPM as defined in IFRS 18. So there is a definition around MPMs. One thing is it needs to be a subtotal. So it needs to be a net number that you need to present. So some of the examples that we're thinking of is headline earnings per share, which is an adjusted number. That's a JSE requirement for reporters. What does this mean in IFRS 18 world? Some, industries report very specific measures. Cash costs, for example, are one. What does that mean? So those are types that, across industries are being presented. How do we think through this in IFRS 18 land? So those are the kinds of measures we're looking at.
Thanks, Liandie. Do you have any more practical tips or insights for preparers as they start thinking about the financial statements of the future?
Shreeya, and I think it is an opportunity. The effective date, 1 Jan 2027, feels like it's a while away, but, it comes with a comparative, 2026. And it also has, if you're a June reporter, if you go out with half year, it kind of shortens the timelines by 6 months because, the information already has to be reported in the half year. So there is, as we've seen the trend with new accounting standards, they're not getting shorter, they're not getting easier. So this is, in that same vein. It is a long accounting standard. There's a lot of guidance out there. So it is a challenge to work through, but there is time, right? So I would say the starting point is to take a TB and say, if I were to report this in December, what would it look like? To identify, the extent of work required, complexity, questions that come up, reporting change that might need to be made, template changes, what information now needs to be gathered that wasn't before. What do we do with foreign exchange? What do we do with, information that we don't have that we now need because, IFRS 18 has required this of us. So that would be the starting point. And then I think, we're on this journey together. So if there are questions, we're here to help. And I think on that, the board has also, as part of their process, published some guidance, some decision trees to make adoption simpler. And PwC also has really good guidance on viewpoints and, even some industry-specific points. So if you are operating in a specific industry, what are those, hot topics, the focus areas that these are the areas that should probably be top priority. So that's helpful as well.
Thanks, Liandie. I think we've had a really great conversation reimagining the possible and what IFRS 18 can mean for preparers and users alike, given that it stemmed from a specific request for comparability. Today, we've chatted about IFRS 18, a brand new financial reporting standard. Liandie's call to action for us all is to start taking a TB, take the TB, and start thinking critically through those categories for your income statement. Think a bit about your balance sheet and consider those tweaks to the statement of cash flows. Early engagement and preparation is key. This doesn't seem like an accounting standard we can just journal away at the end of the day. Thank you for your time, Liandie.
Thanks, Shreeya.
And join us next time for our next episode in accounting, where we explore yet another new accounting standard, IFRS 19.